Welcome to my channel. I'm Scott, and in this video we're going to talk about the price to sales ratio. The first slide is a high-level explanation on the topic. Then I'll show you a simple calculation, how to interpret it. We'll do a high price to sales example, a low price to sales, and I'll tell you an investment of mine that could have the lowest price to sales in the entire market, but it's a terrible investment. I'll show you the current price to sales by industry, the S&P's price to sales historically, a summary, and then I'll show you the price of sales of every single stock in the entire market. So let's talk about the price of sales on a high level. The formula is market cap over revenue, and you want to take the annual revenue, the prior 12 months. Another way to calculate it is take the current stock price over the revenue per share. Revenue per share is annual revenue over shares outstanding. Sometimes people call the price of sales the sales multiple. If you're watching Bloomberg and the analyst says Apple is trading at 7 times sales, that just means they have a price to sales ratio of 7. A big benefit of price multiples, it helps you compare companies. So the PE ratio, price to sales, price to book, you can compare companies of different sizes. The price to sales is also a good way to track a company over time. So if you're tracking a company for the past couple of years and their price to sales is getting lower, that could mean it's a good time to invest in that company. My favorite thing about the price of sales is you can compare companies with negative earnings. The PE is the most popular ratio, but you can't use the PE for a company that has negative earnings. Negative earnings means negative net income on the income statement. If you're looking at two companies, one with positive earnings, one with negative earnings, you can still compare them using the price to sales ratio. Let me show you a simple calculation. You only need two numbers to calculate the price of sales. The first is the market cap. You can find this on any financial website. If you want to calculate it, it's the stock price times the shares outstanding. And let's say in this example, it's 200 million for the company we're looking at, meaning the market values this company at $200 million. And we want to take the revenue for the past 12 months. So we should look at the trailing 12-month revenue. We could sum up the last 4 quarters, and the revenue is on the top of the income statement. Sometimes it says sales on the top, but sales and revenue are the same thing. And let's say in this example, the company has 100 million of trailing 12-month revenue. So their price of sales would be 200 million market cap over 100 million revenue. So you're paying $2 for every dollar of revenue. Let's say the following month, the stock shoots way up. The market cap is 400 million. Now the price of sales is 4. So the stock is twice as expensive as it was last month, because you could see their revenue didn't change, but their market cap went up. So now you have to pay $4 for every dollar revenue. Let's say a month later, the stock crashes and the market cap is down to 100 million. Now it's trading at a big discount. The price of sales is 1. What a great deal, right? You only pay $1 for $1 revenue. Now that you understand how to calculate the price of sales, let's try to look into it a little deeper. If a company has a high price to sales ratio, it could mean the stock is overvalued and you should stay away. Alternatively, it could mean the company is expecting great growth in the future and it might be a good time to buy the stock. If you see a company with a low price to sales, it could mean the stock is way undervalued. Or this could indicate the company may struggle in the future and their revenue will decline. You always want to compare the price of sales to similar companies, and you'll also want to compare it to the same company over time. Say for instance, company X has a price of sales of 3, and the industry has a price of sales of 5. So this tells us company X is better at turning investment dollars into sales when compared to its industry. Let's talk about a company with a high price of sales. Say the company we're looking at has a $500 million market cap, and their trailing 12-month revenue is $5 million. So that's a really small amount of revenue for a $500 million company. So their price to sales is really high, which indicates it's really overvalued. It's 100, 500 million over 5. Why would anybody invest in this company if it's so overvalued? Maybe the company's a really good investment because they invented a new product that's going to replace a lot of other products. But just because you built a better mousetrap doesn't mean you're going to grow a successful company. Because without proper execution, the company may not be successful. Because even if you do build a better product, you have to get people to switch over to using your product, which is not always an easy task. What if you built a new semiconductor chip that's better than NVIDIA's, it's cheaper and it's more efficient? You have to convince all these big companies to switch over to using your product. What if those companies spent a lot of money retrofitting their factories to use NVIDIA's chips? It's not like switching over to a new ride-sharing company, because if a new company came out, I can try them out pretty easily and decide whether I wanted to go with the new company or continue using Lyft or Uber. And also it takes a lot of money to market a product. First, you need a better product or service, then you need to tell people about it. And sometimes you have to tell people many times before they switch over, and that costs a lot of money in marketing dollars. And to go back to my semiconductor example, it's very expensive to manufacture semiconductor chips. A lot could go wrong. Building 1 or 2 products as a prototype is a lot different than building hundreds or thousands or millions of products that work just as well. Now let's go through a low price of sales example. Say we had a company with a 10 billion market cap, trailing 12-month revenue of 10 billion, and price of sales of 1, 10 billion over 10 billion. You may be wondering, why is the market cap so low? $10 billion with 10 billion of revenue. Shouldn't the market cap be a lot higher? But what if the company is continuously losing money year after year and people are starting to get upset and they're selling off their stock? That's why the stock price is getting low. One way to decide if the company is undervalued is to compare it to a company that's already profitable. Say there's a company that's already profitable that also generates 10 billion of revenue, but their market cap is 100 billion. That means that other companies' price of sales is 10 and yours is 1. So that may indicate maybe this stock is a good investment. It could also indicate this company is really bad at managing their expenses. But it is really common for a company to sacrifice profits in early years for greater profits and greater revenue in future years. Because in order to scale and grow and become a big successful company, you probably don't want to grow at 5% a year. Because not many people would invest in your company, because they may be able to get similar investment growth with a bond. They're looking for really big growth. A stock that can double, triple, 5x, 10x, that's what people are looking for. So if you see a really low price of sales, it could be a value trap. It could be a company that's selling obsolete products. Say it's in the early to mid 90s and you're looking at a company that sells landline phones. Everyone in the United States has a landline phone at this point, and pretty much everybody in every developed country and most people in developing countries have landline phones. So it's a really big business. So if you look at that phone company's sales the last 12 months, they're pretty high and their market cap is low. And the reason it's low is because investors know that cell phones are going to take over landline phones and they're going to be obsolete products at some point. Because anytime you look at ratios, it's always looking at the past. It's never looking at the future, because nobody really knows the future. And I've seen a lot of companies have an amazing price to sales ratio below 0.1 right before they go bankrupt. Because if a company is continuously taking on debt to grow their business, it could be a problem if interest rates go up or the capital markets freeze. That's the main reason Blockbuster went bankrupt. It's not so much Netflix. It was because they had so much debt on their balance sheet, and when the capital markets froze up in 2008 and 2009 during the Great Recession, they couldn't refinance their debt and they were forced into bankruptcy. That's something you have to consider when you look at the price of sales. It doesn't take into account debt. It's just market cap over revenue. So if you're looking at two companies, both with a price of sales of 2, but one of them has a lot of debt and one of them has a little debt, probably the company with a little debt is a better investment. Because when you take on debt, your expenses go up because you have to pay the interest on your debt, which requires higher revenue in order to service that debt. A way to fix this problem is replace market cap with enterprise value. So the price of sales is market cap over revenue. Instead, you can use enterprise value over revenue, and that takes into account how much debt a company has. Enterprise value is market cap plus net debt. Net debt is how much debt a company has minus how much cash they have on the balance sheet. I'll tell you about my business idea and we'd have the lowest price to sales ratio in the entire market. When you see a really low price to sales ratio, that could indicate the company's undervalued. But in this case, it would be a terrible investment. Our market cap would be really low and we would have more revenue than Amazon, Tesla, and Apple combined, guaranteed. So our revenue can be infinite if we wanted it. That means we'd have an extremely low price to sales ratio. You're probably wondering, what is this business idea? We're called the $100 Bill Corp. It's pretty simple, our business model. We have boxes and boxes of $100 bills, and we sell them for $99. You may be wondering, why would anybody invest in this company? It's a terrible idea. You'd be surprised on how many companies become publicly traded that are terrible ideas. And after they go bankrupt, it makes so much sense why they went bankrupt. Before they go bankrupt, it seems like a great company. After the fact, everything makes sense. Part of growing a successful business is being a good politician. You have to really sell and spin your business. So when I go out and pitch my idea to venture capitalists, hedge funds, investment banks, I would get them all excited about my business. I would say, don't focus on the fact that we lose $1 every time we make a sale. We would have people lined up around the block to pay $99 for a $100 bill. Our website would be flooded with everybody interested in buying our product. We're gonna sell ad space in our store and on our website. That's how we make money, because everybody is visiting us. We'd have everybody around the world going to our site. And then these investment banks would think, wow, this is a pretty good idea, selling $100 bills for $99. I'll invest $50 million into your company. And there's a lot of terrible, terrible ideas, and this is what happens. You have an amazing salesman and people invest in the company. Lots of companies have lost leaders. Every time they sell a product, they lose money. The idea is to get the customer to buy products that the company has a really high margin on. Like when I was in college, they used to give away free pizza and chicken wings at the bar, hoping people will buy $8 drinks. And that's how they make their money. Same thing with us. We're gonna lose money every sale, but we make money on advertising. Eventually we go bankrupt as a company, but you can see that we would have an amazing price to sales ratio because we'd have a ton of sales. So this is what you call a value trap, a company that would never be successful, but its ratios look pretty good. Here's a breakdown of the price to sales by industry. If you wanted to invest in Kroger, the supermarket, and they had a price to sales of 1, that would be a terrible price to sales ratio for that industry. But if you looked at Intel, a semiconductor company with a price to sales of 1, that's an amazing ratio for that industry. So ratios are really good to compare to other companies, especially companies in the same industry. But any two companies are pretty unique, so you don't want to always rely on these ratios. You want to kind of kick the tires and look beneath the hood. Here's the price to sales of the S&P 500 since 2001. I was hoping to find a chart that went back further, but I couldn't find it. You can see even though the market has dropped a lot since the beginning of the year, it still appears overvalued compared to the prior years. Because at one point during the bottom of the Great Recession in 2009, the price to sales was below 1. And then it more than tripled from that point to above 3 recently. So just according to this ratio, the market still seems overvalued. But of course there's more to look at than just the price of sales. So to summarize, when you see a price to sales of 5, that means the value of the company is equal to 5 times its annual earnings. But price to sales is not ideal for every company. I wouldn't use it for a bank or insurance company. I'd use price to book. And it's not good for asset intensive sectors, like most REITs. I came up with an example to convey why price to sales may not be good for certain companies. Let's pretend you're a real estate developer. You're 40 years old, you recently quit your job, and you're looking to just buy properties and rent them out. You already bought 3 properties, and your goal is to get to 10 properties. You feel like that would be a good number, because if you got a lot more, then you would have to start managing a large group of people, and you don't want to do that. And you spend roughly $500,000 per property. And you really focus on buying real estate in your neighborhood, so it's easy to manage. So whenever you find a property, you go to the bank, you get a loan from the bank, you fix up the property a little bit, then you find a renter. So far you have 3 properties, seems like things are going well. And once in a while you get investors, either friends or family or acquaintances, that ask you about your company. And you're open to investors. You're not dying for investors, you're not going to go bankrupt soon, but you're open to it. But it seems like every time you talk to someone and explain your business model, they don't want to invest. You tell the investor you're not going to get any returns for 15 years. Then after 15 years, you may double, triple, quadruple your investment. You could, of course, lose money. There's no guarantees. And a lot of people say, well, 15 years is too long. I may need the money earlier. And what if the real estate market declines? What if interest rates go up a lot? Since you're taking loans from the bank, it's going to cost you more money to get a loan. And these are all valid points, and you understand. You don't hold it against them. But in your mind, this is a good investment. In your mind, you're going to make a lot of money because you're 40 and you plan to retire at 55. That's why you got these 15-year mortgages. When you find renters for your homes, you set it up where 100% of the rent payment either goes to the bank for the mortgage payment or to maintain the property. There's no profits. It's a break even every single year. So if you see a company like this as an investment, you probably wouldn't want to invest either. Because the company's not profitable, you won't get a return for 15 years. But in your mind, you know this is a good business. But how could it be a good business without any positive cash flow? It's a break-even business for 15 years. Let me explain why. Because if you have 10 properties and they cost on average $500,000 and you got 15-year mortgages, that means at the end of 15 years, say the properties didn't go up at all in value, which is pretty unlikely, but say that happened. You would get $5 million because you could just sell the properties and get $5 million. There'll be no mortgage left because you had 15-year mortgages. And that's your retirement. Of course, you might have to pay some taxes, but that's a pretty good chunk of money. And that's not even likely to occur. What's likely to occur is the properties double, which is about average. It would double in 15 years. So you would have $10 million in a likely scenario, which is a pretty nice nest egg to retire on. Of course, if you time the real estate market really well, you can 4x your investment in a 2-year span. But you're not looking to time the market. You're going to hold it for 15 years. Whatever the value of the property is at that point, you're going to sell it, and that's your retirement. So that's 15 years of work. You get $5 million. That's over $300,000 a year. And that's an unlikely scenario. A likely scenario is the property's worth $10 million after 15 years. That means for the past 15 years, you made on average a year over $600,000. Now do you see why sometimes cash flow or certain ratios are hard to use when looking at companies? But no one saw your vision when you tried to pitch them on your company. They didn't want to invest. Of course, this is a really extreme example because you do need money to live. You probably wouldn't set it up where it's break even. That's why when you look at one number when you invest, it really doesn't make sense. You have to look at a lot of things. Revenue, profit, debt, your competitors. There's so many things you need to look at. After this point, I'm not going to talk anymore. You're going to see the price to sales ratio for every single company that trades in the United States. So stay tuned and look for your company.